All right, this is from Chapter 7, Section 7, Understanding Stock Tables. Here is a listing example. You can see that, I know it's a little faint there, but that says NASDAQ. That is the stock exchange that this listing is listed on. Its ticker symbol as it streams across, that's the shorthand version of its name. This is the name of a company, Computer Programs and Systems, Inc. Its current price. Um, and notice that the price at which the stock was last purchased, remember, its price is set by what people are willing to pay for them. Okay. How much it's, how volatile it is, right? By how much it's changed in its current session today. It's an increase of 11%. It tells you what time. So it's always continually updated. Okay. And then here's some background. Yesterday it closed at that. Today it opened at this. There's a difference. Remember, the current price is who just paid for that price. So that's what somebody bought it at when it opened. And number of shares offered to bid, offered to sell. This is what someone is offering to buy for, so a little less than current price. Someone is asking to sell it right now at 52. Okay, so they think it's going up and they think somebody might pay 52. That would make it be the last number sold. Its yearly target date estimate. Um, Let's see. This one says next time the company expects to release data on how well they're doing. So their earnings report is their estimated date. Highest or lowest price in the session today and in the last full year. Let's see. Right here, total value of the company, the number of shares times the current price. And the dividend paid per share. So if they made profits and they didn't plow it back into the company, they gave their stockholders dividends. Dividend paid per share and what percent of the current price that represents. So they paid 5.5% dividends. And I couldn't write all of them in the same one, so I did another example talking about all the ones I didn't talk about on the first one. So this is Walmart. It's on the New York Stock Exchange. That says NYSE, New York Stock Exchange listing. Obviously, it's a large company. Its current price, it's a little down for the day. Previous close, previous open. Let's see, 1 year prediction. This beta line here, it says volatility. Closer to 1 is stable. As far as about the same stability as the overall market, and lower numbers mean even more stable. So I don't know, about halfway. So about in the middle. Let's see, this one here, volume traded, number of shares traded daily over the last 3 months. Lower volume, more difficult to trade due to availability. So average volume. So how much does it get traded? Does it go up and down? These are all things investors look at. Their PE ratios, price to earnings ratios, current price divided by their EPS. The EPS, earnings per share, the amount of money the company has made for each share of stock. And then, let's see, dividend yield. Let's see. Total number of shares is your market cap divided by your current price. Annual or the last 12 months, your earnings per share is previous close divided by EP ratio. So there's some formulas we may need at some point. And then I want to talk about the PE ratio just a little bit. When we're talking about the price to earnings ratio, If the company has new earnings or it has negative earnings or a loss, it's below, it just says NA. Okay. If it has a PE ratio of 0 to 10, the stock may be undervalued, making it a good buy, or the earnings are about to decline. So that doesn't, so it's kind of weird how you think about whether it's a good, bad number. 10 to 17 being sold at fair market value. That seems pretty like a safe PE ratio. 17 and 25, the stock might be overpriced at the moment, or earnings are expected to increase dramatically. Okay. So it still sounds like kind of a good number, but then again, if it's overpriced, you know, it's a speculative thing, right? If you think the stock price is going up, you might put it out for sale at a higher price, but some people may believe that is overpriced, that they don't believe that it's going to be worth that much, that it's going to go up. But then others may just have an anticipation that it will go up. So it's kind of a, it is what it is. It's a mathematical calculation. So it's the interpretation is up to the investor and stockbroker. Stocks may be very overpriced, earnings unusually low recently, or expected to have a huge jump. I mean, this is kind of gambling here, right?